The Dow Jones just closed below 50,000 for the first time in weeks. The Nasdaq dropped 2% in a single session. And the cause? A combination of war, hot inflation, and a crisis of confidence in AI stocks. Most people think safe markets get shaken by bad earnings. What actually moves markets is fear. And right now, fear is everywhere. This morning, markets are sitting on a knife edge. Here is everything you need to know before the market opens today. Let's start with the story behind every single market move right now. The United States and Iran are in active military conflict. This war began back in February, but this week it has escalated sharply. On Wednesday, Iran fired ballistic missiles at U.S. forces stationed in Kuwait. Thursday morning, President Trump posted on social media. He said the U.S. would hit Iran very hard tonight. He also threatened to take total control of Iran's oil and gas industries. That includes the critical Karg Island export terminal. Why does this matter to you as a trader? Iran sits right next to the Strait of Hormuz. 20% of the world's oil flows through that single choke point. Any serious threat to that waterway sends energy prices flying. Brent crude oil is sitting around $92 a barrel this morning. That is a level we have not seen consistently for years. And oil this high means inflation stays high. High inflation means central banks keep rates elevated. Higher rates hurt stocks, especially tech stocks with high valuations. So this one geopolitical story connects every single market today. Keep that thread in mind as we go through each asset class. What most people don't know is that the energy shock is now forcing the ECB to raise rates for the first time since 2023. That matters enormously for European bonds. We will get to that in a moment. Let's talk about Wall Street because Wednesday's session was brutal. The Dow Jones fell nearly 1,000 points. It closed at 49,918. That is the first close below 50,000 since mid-May. The S&P 500 dropped 1.6% to finish at 7,267. The Nasdaq slid 2%, closing at 25,170. The VIX, the so-called fear index, surged sharply. So what actually triggered the sell-off? A company called Supermicrocomputer, ticker SMCI. SMCI announced it was raising $7 billion through new share issuance. The stock plunged nearly 28% in a single session. Now here is why that shook the whole market. SMCI builds the AI server infrastructure that powers data centers. Its $7 billion raise signals that AI companies need enormous capital. Alphabet recently raised $85 billion. Meta is doing the same. Investors are waking up to a simple question. When does all this AI spending actually generate returns? The profit is not there yet. The capital requirements are massive. That is what cracked confidence on Wednesday. But here's the surprising part. Not every tech stock fell. One company posted record results and the market barely noticed. Stay with me because that story matters for where tech goes next. Oracle reported after the close on Tuesday. Revenue hit $19.2 billion for the quarter. That is 21% growth year-on-year. Cloud revenue surged 47%. Cloud infrastructure, the IaaS segment, grew 93%. Oracle is quietly becoming one of the most important AI infrastructure plays. While SMCI sells the hardware, Oracle sells the cloud layer above it. If you are looking at US tech with fresh eyes today, Oracle is worth watching. Now here is something that might surprise you. While Wall Street was falling apart on Wednesday, London was actually rising. The FTSE 100 added 30 points on Wednesday, closing at 10,258. On Thursday morning, it extended gains, adding another 61 points, up to around 10,319. UK banks led the charge. HSBC rose over 2%. Standard Chartered climbed nearly 3%. Barclays and Lloyds also moved higher. Why are UK banks performing well while US tech is collapsing? Banks benefit from higher interest rates. Higher rates mean better lending margins. With inflation staying stubborn, rates are staying elevated for longer. That is good news for Barclays, HSBC, and NatWest, There was also a notable corporate story in UK equities. Fraser's Group made a €2 billion offer to acquire the remaining stake in Hugo Boss. They offered €38 per share. This is Mike Ashley's retail empire making a major European fashion play. There was also pain in UK equities. Halma fell over 10%. This came despite the company reporting higher annual profits. The market appears to be pricing in slower future growth. If you trade UK stocks, Halma's move is worth watching as a buying opportunity or a warning. In Europe, the picture is similarly mixed. German Bund yields, the benchmark for European borrowing costs, are sitting just above 3%. That is a 3-week high. And the reason for that comes next. If you find this briefing useful, please subscribe. We do this every single trading day. You get the news, the numbers, and the tradable ideas. Hit subscribe now so you never miss a briefing. This is the section most beginner traders skip. Do not skip it. This is where the real signals live. Today, the European Central Bank raised interest rates by 25 basis points. This is the first ECB rate hike since 2023. Let that land for a second. Europe was cutting rates just months ago. Now it is hiking them. Why? The ECB has revised its inflation forecast up sharply. It now expects headline inflation to hit 3% in 2026. That is up from a prior forecast of 2.6%. The driver is oil prices, which are being pushed up by the war with Iran. When the ECB hikes rates, European government bond prices fall. Bond prices and yields move in opposite directions. So German Bund yields are rising, sitting above 3% this morning. For traders, rising European yields mean European government bonds are under pressure. It also means borrowing costs for European companies go up. That is a headwind for Eurozone equities, especially growth stocks. Now, across the Atlantic, US Treasuries tell a different story. The May CPI data just came in hot, a 3-year high. But here is the twist. Most of that inflation came from energy. Energy drove over 60% of the monthly CPI increase. Core inflation, stripping out energy and food, came in at just 0.2% monthly. The Fed faces a genuine dilemma. Headline inflation is high, but the source is geopolitical, not economic. You cannot cure expensive oil by raising interest rates. The next FOMC meeting is June 16th and 17th. Markets are watching closely. The Fed is almost certainly on hold. That means US Treasury yields should stay relatively stable near term. But here is what most people are missing. Gold just overtook US Treasuries as the world's most held reserve asset. The last time that happened was 1996. That tells you something important about where central banks think the world is heading. Let's bring this back to commodities because this is where the war premium lives. Brent crude is at $92 a barrel this morning. The U.S. is threatening to take control of Iran's oil infrastructure at Karg Island. Iran has previously threatened to block the Strait of Hormuz entirely. If even partial disruption occurs, analysts say $100 oil is the base case. That would send inflation even higher globally. The trade idea here, energy stocks and ETFs that track Brent crude. UK energy names like BP and Shell tend to benefit when oil prices rise. Defense stocks are also worth watching given the ongoing conflict. Now let us talk about gold. Gold is at around $4,177 per ounce this morning. That is actually down slightly from recent highs near $4,450 in early June. The ECB rate hike and hot CPI data caused a short-term sell-off in gold. When inflation data comes in hot, some investors sell gold to cover losses elsewhere. But the bigger picture for gold remains very bullish. Central banks now hold more gold than US Treasuries for the first time since 1996. China, Poland, Turkey, and India have all been buying aggressively. The ECB itself confirmed this structural shift in a report this week. Gold is no longer just a hedge. It is a reserve asset replacing treasuries. For longer-term traders, dips in gold like this morning remain buying opportunities. The structural story has not changed. Let us bring this all together into a clear picture. The dominant theme today is fear plus inflation plus geopolitical risk. In US equities, the AI trade is under pressure. Avoid chasing momentum in names like SMCI right now. Instead, watch Oracle. It reported excellent numbers. If the market stabilizes, cloud and infrastructure names like Oracle could outperform. In UK equities, UK banks are the relative strength play. Higher rates for longer means better margins for Barclays, Lloyds, HSBC, and NatWest. The FTSE 100 is holding up better than US indices. That is partly because it is more weighted toward energy and financials. In Europe, the ECB rate hike is a negative for European growth stocks. But it is positive for European financials, banks especially. In commodities, oil is the live trade. Brent at $92 with Trump threatening to strike Kharg Island overnight. If that strike happens, expect oil to gap higher at the open. Energy stocks and oil ETFs are the vehicle. In gold, the short-term move is slightly down, but the structural trade is long. Any dip toward 4,100 would be a level many traders will be watching closely. In bonds, avoid US Treasuries until after the FOMC meeting on June 16th. The Fed is stuck between hot headline inflation and a geopolitical oil shock. That uncertainty means Treasury prices could stay volatile for the next week. That is your full briefing for June 11th, 2026. War in the Middle East. An ECB rate hike nobody expected a year ago. A brutal sell-off in AI stocks led by Supermicro's $7 billion raise. And a gold market quietly telling you that the financial system is shifting. Every single one of these stories connects to the other. That is the skill of reading markets, seeing the thread that ties it all together. Watch our next video to find out what actually happened in markets today. Did oil spike? Did Wall Street bounce or fall further? We cover it fresh every single morning. Subscribe so you are ready before the market opens. See you tomorrow. Disclaimer. This content is for educational and informational purposes only. It does not constitute financial advice. Always do your own research before making any trading or investment decision.